Look, if you've checked your portfolio lately, you know the S&P 500 has been on an absolute tear in early 2026. But if you're feeling a bit of vertigo looking at those 6,800 plus levels, you're not alone. To understand where we're going, we have to look at the scars the market has earned over the last 25 years. Today, we're breaking down the anatomy of the crash and the surge. Let's get into it. First up, the dot-com bubble. This was the ultimate oops moment between 2000 and 2002. We saw a 49% drop because everyone was buying tech companies that didn't actually make money. Sound familiar? Hold that thought. Then, we had the housing-led boom, followed by the global financial crisis of 2008. This was the big one, a 57% wipeout. If you held through that, you saw the longest bull market in history from 2009 to 2020. This was the era of free money, low interest rates, and the birth of the big tech giants we know today. Fast forward to early 2020, the COVID crash. It was the fastest bear market ever, dropping 34% in weeks, only to skyrocket 100% back up thanks to massive stimulus and everyone buying stay-at-home tech. But by 2022, the party ended. Inflation hit, the Fed hiked rates, and we saw a nearly 20% correction. Then came the roller coaster of 2025. In February, the market hit a massive speed bump when the Trump administration kicked off a global trade war. We saw a sharp tariff shock as duties were slapped on Canada, Mexico, and China. Markets went into a tailspin, with the S&P 500 sliding into correction territory, dropping about 10% to 15%, as investors panicked over higher costs and broken supply chains. But, in true modern market fashion, it didn't last. By the summer, things stabilized as the AI supercycle took back the wheel. From mid-2023 through 2025, we've ridden a 60% wave of pure AI hype and a soft landing for the economy. So, what's the blueprint here for 2026? There are three things you have to know. 1. Bulls are marathons, bears are sprints. Bull markets usually last 5 to 6 years, while bears are usually just 1 to 1.5. The math is simple. Time in the market beats timing the market. 2. The V-shape trap. Don't let 2020 fool you. Most recoveries take years, not months. If you need your cash soon, don't keep it in volatile stocks during a downturn. And 3. The top-heavy problem. Right now, the market is incredibly concentrated. A few AI megacaps are carrying the whole team. If they trip, the whole index falls. As of early 2026, we're trading at some of the highest valuations we've ever seen. We're essentially paying perfection prices. This means if a big tech company misses earnings or a geopolitical spark flies, things could get bumpy fast. The boogeyman isn't just a recession anymore, it's sticky inflation. That's what's keeping the Fed up at night, and it's what should be on your radar too. The AI tailwind is real, but the margin for error is razor thin.